Good morning. My name is Laura Beck. I am a partner in the Greenwich office of Cummings & Lockwood, and I just want to start by welcoming all of you. I have the what is sometimes enviable and sometimes unenviable task of talking to you first about Connecticut and federal tax law changes. I did this topic last year and they slated 4 minutes for me and I couldn't fill the 4 minutes. There were no changes in Connecticut's tax law last year, and all we knew about the federal proposals were that the Trump plan had said there would be a repeal of an estate and gift tax and no details on the how, the why, or the when. This year they gave me 18 minutes and I could speak all day. And as I spoke, I could keep looking at my phone and getting updates as to what's changing and what's obsolete that I said 5 minutes earlier. So I'm not going to do that. I am happy to say we have some changes that we know about already. Connecticut has finally made some changes we can talk about in their estate and gift tax laws. Earlier this year, Connecticut passed its new budget, and as part of that budget bill, Connecticut changed the exemptions in its Connecticut and gift tax rates. Starting January 1st of 2018, so in a couple of weeks, Connecticut's exemption from estate and gift taxes will rise from $2 million to $2.6 million. January 1st of next year, 2019, that exemption will go up to $3.6 million. And interestingly enough, not having foreseen what the federal government might be doing, Connecticut said beginning January 1st, 2020, we're going to match the federal exemption. Whether that holds in January 1st of 2020, if the federal estate tax exemption is doubled as is being proposed, and I'll talk about in a minute, we don't know yet. Certainly Connecticut has time to figure that out and make an adjustment to the law. And we don't know what this law means if the federal estate tax is repealed, because it really is tied to the exemption. And so the question becomes, if there's no exemption, does that mean Connecticut has no exemption but still has a tax? Or does that mean that Connecticut is not going to have an estate tax? I guarantee you Connecticut will figure that out at some point. But as of right now, the way the law reads, we are gradually scheduled to increase until 2020 when we meet the federal exemption amounts. Connecticut also has an interesting provision that I don't think any other state has that has an estate tax, which is we have a cap on the maximum amount that a person can pay in combined gift and estate tax in Connecticut. That cap was set a couple of years ago at $20 million, which represented that's the tax that you would pay. So a $20 million total tax, which represented about $168 million estate. So if you were lucky enough to have more than $168 million, anything over that you could gift or pass on at death tax-free. Connecticut reduced its cap as part of this budget bill, and now the cap is $15 million, which under current rates and law is about $129 million estate. So all of you with more than 129 million, rest assured, everything over that you can pass on tax-free in Connecticut. Connecticut did not change its maximum tax rate. The rate remains at 12%, but as a result of the changing in the exemption amounts, the rates do change a little bit, and there's a chart there that shows you some of how those rates change. The chart's a little confusing. And I don't take responsibility for it. The Senate actually provided, the state Senate provided this chart. But what's clear to me from the chart is they weren't contemplating that the federal exemption was going to get above 6.1 million anytime soon, which is how they kind of drafted that chart. But what the law is clear is that the Connecticut exemption will match the federal exemption starting January 1st, 2020, unless they change it before then. But so you can see that at some levels, the rates actually change a little bit, but the maximum rate remains the same. And that's basically what we can say with certainty about Connecticut's tax laws. I have a little bit more certainty on federal tax laws before we get into the uncertainty. The federal tax laws that we know about, federal tax law changes that we know about for sure, for now, are the increased exemption amounts that are scheduled to go into effect January 1st, 2018 because of the inflation indexes on those exemption amounts under current law. So absent some changes between now and January 1st, the federal estate, generation skipping, and gift tax exemptions will be increased to $5.6 million per person, which is a lot easier to say than the current $5.49 million or $5,490,000. And our annual exclusion amount is scheduled to go up finally. That is also indexed for inflation, but doesn't jump very often. It has been set at $14,000 for the last few years. It will go up to $15,000 in January of 2018. And the non-citizen spouse annual exclusion amount, the amount that you can give to a non-citizen spouse without using any gift exemption and without creating any gift tax in any given year, is rising to $152,000. The big question, though, is this even relevant? Will something change between now and January 1st in the overall structure of the estate, gift, and GST taxes at the federal level? What we know so far is that a bill has passed the House. The House proposal contains a provision to double the exemption amounts effective January 1st, 2018. So the way the law reads, that's a doubling from $5 million to $10 million, but indexed for inflation back to 2011. So what that would mean is, as of January 1st, 2018, the exemptions would be doubled for the estate, gift, and generation skipping tax to $11.2 million per person, and still indexed for inflation to rise thereafter. The House bill also would repeal entirely the estate and generation skipping taxes as of January 1st, 2024. After that, the House would retain the gift tax, but at a reduced rate of 35%, down from its current 40%. And amazingly enough, the House proposes that even after there is no estate tax, they would retain a full step-up in basis at death for the date-of-death values of all assets included in the estate. So they're kind of giving the best of both worlds. No estate tax, but the benefit of a full step-up in basis for income tax purposes when the assets are passed on to heirs. That bill has passed the House, and the Senate is currently debating their version of the bill, which as of right now contains the following provisions. The Senate proposal would also double the exemption amounts effective January 1st, 2018. Those current exemptions would be phased out, however, and there would be no repeal in the Senate bill. In fact, quite the opposite. The Senate bill contains a sunset provision, so that as of January 1st, 2026, the Senate bill would go back to the original $5 million exemption as indexed for inflation. They also would not be reducing any of the rates. So it's a very similar situation to what we saw in the Bush tax bill in 2001, where there was a gradual increase in rates, but a sunset provision where the estate tax was going to go back to pre-2001 rates and exemptions. We all know what happened at the end of 2009 when we scrambled to see what was going to be the case in 2010. We all know what happened in 2010 when we scrambled to figure out what was coming after 2010. And apparently the Senate wants us to go through that again. And interestingly enough, and I'll talk a little bit more about this when I talk about where this is going, the reason for this is in part the Senate rules, which require that they show how they're paying for any of these tax cuts. And they have to make it budget neutral after 10 years or revert back to where they are at the end of those 10 years. So that's where we're getting these sunset provisions from. But this is what the Senate so far has proposed. I'll talk a little bit, and I don't want to go into too much detail because I think so much of this is going to change, but some of the other non-transfer tax proposals in the Senate and House bills, the House is proposing a reduction in the number of brackets for income taxes purposes. They would have a 4-bracket system with the top rate still being 39.6%. The Senate would have a 7-bracket system still, but would reduce the top rate slightly to 38.5%. They would both the House and Senate provisions increase the standard deduction amounts and repeal the AMT. But again, the Senate has a sunset provision on all of this. So both bills look very similar in this regard, but one has permanent income tax changes and one has a sunset. The Commensurate with all of these changes on the brackets is also an elimination of almost all of the deductions that we've gotten used to. Most notable, especially for those of us in states like Connecticut and New York, is the elimination of the SALT deductions, the state and local tax deductions. The House bill has a provision that says eliminate all of those deductions except for $10,000 of property taxes, which could still be deducted. The Senate bill would actually repeal all of the deductions for the state and local tax deductions. There's changes in the way gains on the sale of a principal residence would be treated, and when you can qualify for the $250,000 exemption on those sales. And there's a number of other changes, but these are kind of moving targets, and I don't want to waste your time talking about what may or may not be coming down the pike in the final bill. Of course, the centerpiece of both the Senate and House bills, and the centerpiece of the White House's push for tax reform, is the changes in the corporate tax rates. Both bills currently call for a change in the corporate tax rate down from 35% to 20%. What has become a very contentious discussion in DC, both in the House and the Senate, is what would be done with pass-through entities. So entities that don't qualify for the corporate tax rate but are currently being taxed at the individual owner's income tax brackets, so LLCs and partnerships. House and Senate have very different proposals currently about how to treat pass-through entities. The House bill that passed would impose a maximum rate of 25% on the pass-through entity's business income, which they assume to be 30% of the total income of the pass-through entity, although one could argue up or down on that on their tax returns. The Senate bill has a 17.4% deduction on business income in their proposal. Both of these proposals have what they call anti-abuse provisions, so you can't just throw everything you own into an LLC or another pass-through entity and then take the lower tax rates. But there's a lot of misunderstanding currently about how those anti-abuse provisions would work and what would qualify and what would not qualify. What they've been clear on so far is it would not apply to certain passive entities that don't qualify for business treatment and would not apply to service businesses. But there's a lot of talk still about what it actually would apply to and what would be excluded and how the anti-abuse provisions would work. The pass-through entity issue is an important one because it's one of the things that's becoming a big debate between Republican senators themselves as they decide whether they're going to support the bill that came out of their committee just yesterday. So what is happening now is the House bill, as I've described it to you, passed before Thanksgiving. The Senate bill was reported out of both the Finance Committee and the Budget Committee earlier this week. The Senate voted yesterday afternoon on a procedural vote to begin 20 hours of debate on the bill as it was passed out of committee. And after those 20 hours of debate, they're opening the floor to amendments to the bill, after which they expect to vote immediately on the final bill as amended. When I worked in the Senate years and years ago, when these bills came up where they said we're going to have 20 hours of debate, we're going to have a bunch of amendments, we're going to vote immediately after those amendments on a bill, it was referred to, and ironically this is the time of year for it, as a Christmas tree. You waited to see how many people were going to come and try and hang things on this bill, and whether hanging on one side was going to unbalance what was done on the other side. And so there's a lot of discussion right now about the kinds of things that might get changed before a final bill is put before the Senate. Pass-through treatment is one of them. How are those pass-through entities going to be treated? Will there be changes? Will they look more like the House bill or even less like the House bill? Another thing that started circulating in discussions yesterday and the day before was the idea of putting in some tax triggers. So there are some Republican senators concerned that the revenue projections of this bill are not going to reach what they're supposed to, and what do we do about that if we've reduced taxes and we haven't increased revenue the way we expect to? And they're suggesting putting in tax triggers where they say there will be automatic increases in the tax rates if certain revenue projections aren't met. There are other senators who are saying, no, that looks like a tax increase, and we're not going to go for that. So then another idea was floated, which was instead of tax triggers, how about spending triggers? How about if the revenues don't reach what they're supposed to, we have automatic spending cuts on federal programs other than military programs? That was floating around yesterday. What I wasn't clear on, and these senators I'm sure know more than I do, but there are what they call pay-go rules already in the Senate. Unless the Senate can get 60 votes to override a pay-go rule, the Senate already requires that you score any kind of deficit spending with projected revenues and automatic spending cuts. So I'm not sure if these spending triggers they're talking about potentially adding to the bill are in addition to the ones that are automatically there, or whether they had erroneously thought they had overridden those pay-go rules already. I think that's a lot of what's going to be debated today on the Senate floor. But the idea is that they're going to try to come up with some kind of compromise that they don't lose any votes and they gain some votes, and enough to get to 50 Republican votes to pass this bill. No Democratic senator has said that they're voting for the bill, regardless of any of the changes that have been floated around so far. One other big issue that arose last night was a number of Senate Republicans have said they want to expand the child tax credit beyond what the current bill provides, and that they would intend to pay for that by slightly raising the proposed reduced rate on corporate taxes. So they're talking about having a corporate tax rate of 22% instead of 20% in order to pay for an expanded child tax credit. The White House came out last night and said no. They said it's got to be 20% or the president won't sign it. So that could be another sticking point in all of this. What happens if we get a Senate bill that passes? Process-wise, what happens is the Senate bill and the House bill have to be reconciled. There are two ways to do that. Typically, it goes to what's called a conference committee, where members of the House and members of the Senate sit down, try and hammer out a combined compromise bill that they can both take back to their respective houses to have passed, and then they have both passed, in essence, an identical bill. That's one option. That's another place that things can fall apart if they can't reach compromise, or if they start making changes that lose votes that they hadn't expected to lose. They can have a bill that falls apart. The option that the White House is pushing, and the option that looks most likely to be the only way that this would get passed before the end of the year, is if the Senate passes a bill, to have the House immediately take up that bill and vote on it without changes, so that both the House and the Senate have passed an identical bill that the president could then immediately sign. The president has promised to sign this bill. He spoke yesterday in Missouri, assuring everybody that his tax proposal that he put forth, he will not veto, which is a good thing. I guess he hasn't changed his mind yet. But what remains to be seen is what he considers his tax bill. If there are significant changes, is 22% instead of 20% on the corporate rate a significant enough change that it's not his tax bill any longer, that he would in fact veto it, like the White House said last night? Are there other changes that may come to pass that the White House can't live with, or that lose votes in the House once the Senate has come to a compromise? I don't know. I kind of feel like sitting here and telling you all of this was a waste of your time, because in about 6 hours, I would give a very different speech, I suspect. Tomorrow, I would give a very different speech. What I can tell you is we're monitoring this. We are not going to do a play-by-play in real time on our website, but as we have some level of certainty or some idea of where things are going, we will be posting updates on our website. There is also in the packets that you got today a copy of our annual letter that is currently being printed and mailed out to our clients, which explains in a little bit more detail some of the things I talked about today as we know them, the lay of the land as we know them. And I'll just point one out to you, because I didn't have time to talk about federal tax law changes beyond legislation. There was a case that came out earlier this year called the Powell case, which had a lot of us a little bit rankled on how valuation discounts would be handled and what would be included in a decedent's estate if they gave away an interest in an entity that they owned prior to death. And so that is also written up in our letter. I encourage any of you who have a chance to peruse that between now and the end of our session today to ask us questions about it. Get in touch with us afterwards if you have questions. But I think that wraps up my really bad magic 8 ball of what's happening on the federal estate tax side.